Hello, my name's Darlene Felsch. I'm a certified practicing accountant and an accounting tutor. This is part of a video series I've created for Year 11 and 12 students to fast track them through their studies in just 10 weeks. I hope you enjoy the program. Purchase of inventory on cash and credit. Now we will learn about the accounting entries that happen in a real business. Let's say we have a mobile phone business called A1 Mobile Phones. We buy and sell both new and second-hand mobile phones. We also sell accessories for mobile phones. We also do mobile phone repairs. Our company operates all over Australia. Note, in week 1 we will not be covering accounting entries that relate to the purchase of the mobile phone calls and data, but rather focus on the purchase of the hardware, that is the phone itself, as well as mobile phone accessories. These are more advanced concepts and will be taught in another week. Inventory or stock. In this example, we are introducing the concept of inventory. This is also known as stock. Inventory or stock are all the items we have in our shop to sell to customers. In this example, our inventory or stock is the mobile phones and mobile phone accessories that we purchased in order to sell them to customers. You have probably heard companies say that they are doing a stock take or having a stock take sale. When a business does a stock take, they are counting up how many items of inventory or stock that they have left in their shop ready to sell to customers. Inventory is an asset. It is something that we own. Debtors and creditors. Next, we'll introduce the concept of debtors, also known as accounts receivable, and creditors, also known as accounts payable. Debtors are customers who owe us money. Creditors are suppliers that we owe money to. Debtors are also known as accounts receivable, or AR for short. Creditors are also known as accounts payable, or AP for short. In our business, we need to buy mobile phones to sell them to our customers. Similar to the example with buying a car, look at the money side of the entry first. Purchase of inventory and paying immediately. If you purchased the mobile phones for $5,000 and paid for them with cash out of your bank, the accounting entries would look like this. Just as when we bought the car, you can see that we, number 1, paid the money out of our bank account for $5,000, which was recorded in the credit or the out side of the bank account. Number 2, remember that once you know the money side of the entry, the other entry is always opposite. Number 3, the mobile phones we have purchased are coming in to our shop. That is, we own the mobile phones. So they are recorded in the debit or the in side of the inventory mobile phones account. And number 4, if we were to show the two accounts combined together, you can see that both sides balance. In our combined business accounts, you can see number 1, purchase of mobile phones of $5,000 in the credit or the out side of the bank account. And number 2, purchase of mobile phones of $5,000 on the debit or the in side of the inventory mobile phones account. Purchase of inventory on a 30-day account. Creditors. How would this look different if instead of paying the supplier immediately out of our bank account, instead we paid for it on a 30-day account? The 30-day account with the supplier means that we have 30 days to pay for the mobile phones, rather than having to pay for them immediately. Having an account with a supplier is them giving us a very short-term loan. Instead of a car loan, which we might pay off over a 5-year period, instead this kind of loan is just for 30 days. This means that we now owe the supplier this money and must pay them within 30 days. The term for when we owe money to our suppliers is a creditor. Remember, a creditor is also known as accounts payable. How would this be recorded in the accounting system? The entries are almost identical to the example above where we bought a car with a car loan. On the money side of the entry, we have the creditor or accounts payable. It shows $5,000 in the credit or the outside of the money account, the creditor. Number 2, the purchase of the mobile phones for $5,000 is shown on the debit or the inside of the inventory mobile phones account because the mobile phones are coming in to our business. Here is what it looks like in our combined business accounts. Number 1, purchase of mobile phones for $5,000 on the credit or the outside of the creditor account. This is the money side. Number 2, purchase of mobile phones for $5,000 on the debit or the inside of the inventory mobile phones account. Purchase of inventory on both cash and credit. Okay, let's make 2 purchases for our business now, one on cash and the other on credit. Number 1, we'll purchase mobile phone accessories from Supply 1 at a cost of $2,000 and pay immediately using cash from our bank. Number 2, we'll then purchase mobile phones from Supply 2 at a cost of $5,000 on a 30-day account. How would the debits and credits be recorded in an accounting system? Firstly, purchase of mobile phone accessories at a cost of $2,000 using money from our bank account. Here you can see we have $2,000 going out of our bank account, so it's recorded on the credit side of the bank account. It also shows that we have mobile phone accessories coming in to our business. So the $2,000 is recorded as a debit or an in to the inventory mobile phone accessories account. Next, we'll purchase the mobile phones at a cost of $5,000 on a 30-day account. Number 1, you can see the purchase of the mobile phones for $5,000 on the credit or the outside of the money account, the creditor. And you can see the purchase of mobile phones for $5,000 coming in, so it's a debit to inventory mobile phones. The combined business accounts or the balance sheet would look like this. Number 1, we have $2,000 going out of our bank account for the mobile phone accessories. So this is recorded on the credit or the outside. Number 2, the mobile phone accessories of $2,000 are coming in to our business. Number 3, we show $5,000 for the purchase of mobile phones on a 30-day account. This is effectively money that will be going out of the business in 30 days. And 4, the mobile phones are coming in to our business as stock or inventory. Debtors and revenue. Next, we'll introduce the concept of debtors and revenue. Debtors are customers who owe us money. Debtors are also known as accounts receivable, or AR for short. We gain revenue from selling goods or services. Revenue is also known as income or sales. In our business, we are going to sell goods, mobile phones and mobile phone accessories. And we are also going to sell services by fixing mobile phones for our customers. Note, at this stage, we are not going to look at the accounting entries for inventory. This will be covered in another week. The purpose of this lesson is to teach you the difference between bank account and debtors or accounts receivable. Sale of mobile phone and the customer pays immediately. If If you sold a mobile phone for $1,000 and the customer paid immediately, the accounting entries would look like this. Remember, look at the money side of the transaction first. The other entry will always be opposite. What is happening with money or bank? The customer has purchased the mobile phone outright. That is, they did not go on a plan to pay the mobile phone off. They may have paid with cash or credit card or debit card or BPay or PayPal or direct credit to our bank account, to name a few. Money is coming in to our bank account, so this is a debit to the bank account. What is the other side of the entry? Remember, once you know the money side of the entry, the other entry is always opposite. When we sell goods or services, the other account used is always revenue, also known as income or sales. When the two entries are combined, they look like this. On the money side of the entry, we have sale of mobile phone of $1,000 coming in to our bank, so it's a debit. The other side of the entry is always opposite. So next we have the revenue, sale of mobile phones for $1,000, recorded as a credit. Sale of mobile phone on a mobile phone plan. How would the accounting entry be different if the customer has bought the mobile phone using a mobile phone plan? Once again, what is happening on the money side of the entry? Although money is not coming in now, it is coming in later over time. Mobile phone plans are usually for 24 months. This is like giving the customer a short-term loan to pay the mobile phone off. Money is still coming in, so the first entry has to be a debit to a money account. What money account do we use? Debtors, also known as accounts receivable. The accounting entries would look like this. Here we have our two T accounts, debtors and revenue. On the money side of the entry, we have $1,000 coming in to debtors, accounts receivable. Although the money's not coming in now, it is going to come in over time. So this is our money entry. Once we know the money side of the entry, the other side is always opposite. So the next entry is a credit of $1,000 to the revenue account. The entry is almost identical as when the customer paid for the phone immediately. All that has changed is which money account that you use. Instead of using the money account called bank account, you use the money account called debtors or accounts receivable. In our combined business accounts, we can see that the debtors side, the money side of the entry, is $1,000 recorded as a debit. The other side of the entry, being always opposite, is $1,000 recorded to the revenue account as a credit. That's the end of the lesson for today. I hope that you've enjoyed the lesson. We'll see you next time. Bye.